Hello, and welcome to the market update for Tuesday, February the 2nd. Obviously, a nice update today. We had an update yesterday. The thing that worries me a little bit is the volume behind the move. We'll look at the charts here in just a second. I think there's still some danger that we have another move down, maybe over a couple days to kind of flush out some more of the buyers before we can sustain a stronger rally. So I'll show you that on the chart here in just a second. But as we look at the indicators, the direction alerts here, we're kind of right in the middle on the momentum indicator, all the indicators here. Momentum, we're right in the hold range, the middle range there. Breadth, we're in the trending area, which is right in the middle there. And then sentiment right in the middle here as well into the trending. So, could we just rally from here? We're not in an overbought state. So, it's possible we break out here and move higher. The area we really want to focus on is that previous high, which we'll look at here in just a second. Because that, obviously if you're breaking out, you're no longer in a correction. So, but I'll show you that when we get to the chart. As far as the buy-sell ratios, again, these have come all the way back together again. In fact, they even crossed briefly where the sales moved above the buys. So there's definitely room for this to expand again and to rally from here. So, like I said, we're not in an extreme overbought condition. But like I said, I'm concerned a little bit about the volume over the last couple of days. Lighter we're rallying on lighter volume, which is usually something that happens within a correction. The sentiment is again pulled back quite a bit. We're nowhere near the danger area or the extreme overbought condition. Let's look at the chart though. Let's look at the SPY chart. As we talked about many times, usually when stocks correct, they usually correct in a three-step stage move. Oh, by the way, the training today is going to be, we're going to get further into Elliott Wave. We're kind of building the foundation of the Elliott Wave training. If you missed last week's or last Thursday's introduction, you can go back and review that. We went over just a little bit of what Elliott Wave is and what Elliott Wave analysis is. Today we're going to get into more specifically about what that is. We're talking about the waves, the different waves, but this is definitely part of that process. And what happens is when stocks tend to correct, usually they correct in kind of a three-step move. You have that initial sell-off, and then you get a bounce. And that bounce is often referred to as a sucker's rally. It sucks people in. People think that the correction is over, and then you usually have one more move down before resuming the trend. And that's what kind of forms that ABC pattern. Now, not all stocks follow this process exactly. There's variations of this, of how this kind of forms, but you can see it back here on the SPY back in September. So you had that initial sell-off right here. It tried to rally back up and then rolled over and had one more move down before resuming the trend. So in this case here, though, where we're at, we've rallied up pretty far. Let me put the volume bars on here. But what concerns me is, so we had last week, we had this move down, and it made that move down on very high volume. You see those very high volume days, particularly on Wednesday and Friday. And then yesterday we tried to rally back up, but we did so on lighter volume. And then today, we've only got 2 hours before the market closes. And although it's been a big update point-wise, you look at the volume, is not even half of what it was yesterday. So we're going to have a very light volume day today. And so it worries me that these last 2 days is that sucker's rally, and that we might roll over and have another move down. Now you could say, well, was this the suckers rally right here? And so you had this move down. Here was the suckers rally last Thursday. Then you had Friday's move down, and we're going to go higher. It's definitely possible that that's the case. And if we were to come up here and break out, then obviously the correction's done. That was the correction. But again, this it's just really, really light volume, particularly today. He had this really big up day. Everyone's bullish today, talking about how much the market's up, and yet it's that volume is lagging quite a bit. So we'll see how that kind of plays out. But I would definitely be cautious. I wouldn't be going all in or charging back into positions, dumping money back into GameStop or anything like that just yet, because it could, if it does come back down again, the next significant support area is over here at right here near that 360 area. So that'd be quite a big drop. But I think if it did do that, it would be more like these corrections back here, and we'd get a much better rally off of it, I think, because a lot of times, like I've talked about, you get it in the upper parts of the trend, and the buying tends to dry up a little bit because nobody wants to buy at the highs. They want to wait for a pullback of some sort. Everyone's waiting for a pullback, and if it's a real shallow pullback, it just doesn't last. Sure, it might help a few traders as it jumps right back in, but it's not going to attract the bulk of the buyers that are really going to drive it higher. So it's always nice to get some decent corrections within a trend. That's what can help the trend sustain itself for quite a long time without having now when you really get overstretched and don't get very big pullbacks within a trend, that's when you get the bigger sell-offs, because once it does start selling off, there's so many people in the trade, it's usually referred to as a crowded trade, that everyone's trying to sell at the same time, and it ends up being a much bigger sell-off. All right, if we look at the other charts too, the Dow, kind of the same thing. We're seeing very light volume. The NASDAQ 100. Now this will be interesting too, because there's I believe both Google and Amazon report after the bell, the earnings after the bell, and that could have an effect on how it moves. So NASDAQ 100 again, rallying on very light volume. Russell 2000. And another thing I would add is, one thing I also look at is kind of a leading indicator of the market is the chip stocks. And you could look at the ETF, the SMH, and usually when chips are rallying strong, the market's rallying strong. When chips are lagging, then the market tends to lag. But the chip sector is up a little bit, but today. But so you can see we're up almost 1%. But the way it's trading, it opened up here. It looks like it's going to close lower than where it opened, and but still higher than the day before. We've talked about this many times. That type of price action where you gap up, you open higher but close lower for the day, but still higher than the day before, is usually a very bearish price action. So, again, could this be wave A of the chip correction? Wave B, that suckers rally, we get wave C coming down a little bit, maybe down into this area right here before going higher. And again, all this could be moved by Thursday if we break out. But I'm going to go over a couple of trades today, and the stocks I like, and but I would, for me, I'd have a tendency to want to wait until I get a little bit more clarity on that market direction, and that would be if we break out. Definitely much more likely we're going to go higher at that point, and I'd be much more comfortable buying into that. All right, let's look at take the volume bars off here. let's look at bonds. The trend in bonds has been down. We talked about this. We haven't broken that downtrend yet. Last week, I'd mentioned that this looks like it could be kind of that bearish ABC pattern where we had this drop right here, and this is the correction of that. And it looks to be that now that we're moving lower again. What's interesting here is that very often there's an inverse relationship with bonds, meaning that when the market is going down, usually bonds are going up because usually money is coming out of the market and going into bonds. But we didn't see that last week. In fact, just the opposite. When the market was selling off, bonds were actually dropping, and so there's not that relationship there. So, but clearly, bond market's in a downtrend, hasn't broken that. I'd want to see it break to a higher high right here to at least show that'd be the first signal that possibly reversing that trend. And we just, we'll wait and see if that ends up taking place. All right. Next chart is gold. And whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. And so you have this drop right here, this consolidation right here, and the expectation is that gold has another move down. Now we saw a spike in silver. We saw a spike in silver with and it was kind of associated with that Reddit group or what have you. I do want to comment on that. Retail traders can band together like the Reddit group has done, and they can affect a single stock, particularly a single stock that doesn't have a lot of outstanding shares. I don't think they would be able to do the same thing to Microsoft or to some of these other companies that have tons of outstanding shares. It just takes a lot more to move them. But they're definitely not big enough to move commodity markets. So I think what's kind of I think what's dangerous here, and they're not big enough to move multiple stocks either. Like I said, they can team up on one or two stocks or something like that. But what's going on here is that, yes, the retail traders are kind of banding together and telling you what they're getting into or what they're targeting, but it's still the institutional traders that are jumping on board and trading either with or against those retail traders. And so to assume that these retail traders are going to target a stock and they're going to make that stock go up by themselves, no, it's going to take the bigger money coming in too. But that's what those big institutional traders are doing, is they're seeing what the Reddit crowd is going after, and they're either trading with them if they believe that they can get that stock moving higher and make some money along the way, or they're trading against them. And right now they're trading against them, as we can see with the GameStop down big over the last couple of days. And who knows, maybe they'll decide they want to push it right back up again. And they might end up doing that as well. But it's just, I think it's important to understand that. And it's important to understand the size of, commodity markets, currency markets, things like that. I mean, those are worldwide markets. And so to assume that a small, even a large group of retail traders can affect that is not accurate. And that's, I think, why we're seeing silver come back down quite a bit today. And but anyway, that's just kind of a side note there as it relates to gold or the commodity markets here. But gold still looks like it's pretty weak right here and should have another move lower. Oil, again, that we just saw the whenever you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. I talked about that on gold, but look here on oil. We were pointing this out last week that it was consolidating like this. The previous move was up. It's much more likely that when this is over that we would continue to move up, and we see that today as we broke out of this range. Now, that rule of thumb, so to speak, doesn't necessarily tell you how far the stock will go. I'm not saying that just because we're consolidated here and we're moving up before then that we're going to have that same move up or a bigger move up. It just means that it should continue to move in that direction after it's done moving sideways. And with that breakout gap today in oil, could it reverse and come right back down? Absolutely, it could do that. All that rule of thumb is saying is that there's a high probability that it continues in that upward direction, which it's fulfilled. It's done that today with that breakout move. But it still looks like oil is heading higher, which is a little bit baffling when we understand how much supply there is out there and supply waiting to be dumped onto the market with countries that are ready to take advantage of the higher oil prices to make money. The prices have been so low and they've lost so much money that they've got to be very anxious to add more supply to the market. So I don't know how much longer that uptrend is going to last, but it's clearly there right now and you can't deny it. The dollar, we talked about this last week as well, that we're kind of consolidating through here. We had this move down and we had this kind of sharper move up right here before we started to move sideways. And so I felt like the way it was acting, that we should continue to move higher. We've done that over the last couple trading days. We've kind of started to break out of that sideways range and move up. Again, how much longer that lasts, I don't know, but a rising dollar will also tend to have a little bit of an impact on commodities. It's kind of an inverse relationship a lot of times. It could be a reason why gold is showing some weakness there as the dollar strengthens, although oil isn't. So that's kind of unique there. But maybe that oil rally is going to be short-lived here, that breakout, if the dollar keeps rising. All right. And then last, we'll take a look at the VIX. Now, the VIX has come down quite nicely today. And that could be a sign that the markets well, it is definitely a sign that the level of freaking out by the institutional investors from last week is it spiked up. It's calmed a little bit. Now it's still elevated though. We're still elevated here, but it's trending in the right direction as it's been coming down over the last couple trading sessions. So. And we'd likely, if we do break out, if the market does break out, we're likely to see it come down much further. Because again, those institutional traders are going to see the same thing that we are. That hey, we're breaking out. The market is much more likely to be going higher at that point. I don't need to buy those protected puts and hedge, and so that VIX will probably come back down into this lower area here. So, on the other hand, if we do kind of roll over right here, we could see it spike back up to these levels here. And even if we do get another move down, again, I think it's important. I'm not suggesting that we're going to see a massive correction here. I don't see anything that would indicate that, but just probably a similar move down like we saw last week, and then ready to rip higher again. All right. Let's take a look at a stock in a sector here. Yeah, we've looked at a couple in the retail sector. The last couple of updates here. This FBRR and PDD. FBRR still looks pretty good to me. It looks like it's starting to move higher a little bit here. Again, look at the correction here, though. Look, you had that initial move down. You had this little bounce. Sometimes that bounce is a move higher. Sometimes it's a move sideways. But it just wasn't strong enough to come back up again. And then you had this flush out move down here, and it looks like it's starting to work its way back up. There's a lot of support right down in this area here. So if we do roll over and break that, that would not be very good. It could mean this is maybe even in a downtrend at that point, because then you'd be having lower highs and lower lows. We're going to break through that, so that's something to keep an eye on. But we're waiting for this to go back to a buy signal anyway as confirmation, and it's getting there, but it's still a little ways away from getting that confirmation there. This next one, though, that we've been watching, this PDD right here, has gone to a buy signal today. If that holds going into the close. Now that'll show up tomorrow, meaning it'll be off this list tomorrow because this updates overnight. So if that does stay a buy signal, it'll move into the buy range. Remember, we're pulling up the hold signal. Stocks that have a hold signal, 98 strength rank is what we're looking at. Although this one had a little bit lower strength rank at 95. But again, I like that consolidation through here. So here's you had a impulsive move up. Let me back out a little bit here so we can see. Impulsive move up, corrective move here, sideways. Impulsive move up. This looks corrective. It looks real close to breaking out. Now, we're close enough here to where, again, if you wanted to wait to see if the market breaks out before you wanted to buy anything, this is right at that breakout area too. So if the market were to break out, this would probably end up breaking out with it. And that could be some added confirmation. And that, when people ask me, what my trade management technique is, I don't have a real, I try not to have a real strict system, meaning, I'm not always aggressive. I'm not always conservative in my entry and exits. A lot of it just depends on conditions, right now with a little bit of uncertainty as to which way this market could go. I'd probably want to wait for a little bit of extra confirmation, see if I can increase the probability of my success by being a little bit more patient. So, in other cases, if we break out, the market breaks out, and I see some potential trades that I think are going higher, I'll be very aggressive with the entry into those because, why wait around when the overall market looks like it's surging higher and should draw those individual stocks I'd like up with it. All right, let's look at a couple under computer and technology here. Blink charging, BLNK. We've shown this one before. I've liked this one. It's come back a little bit here. So it broke out right there on that move. That's kind of pulled back here. Now it's real close to going to a lower low. So you definitely want to wait to see if this goes back to a buy as confirmation. But I've liked this stock, and I think this stock is going to be one that's going to be growing over the next several years, particularly with this administration. A lot of these alternative energy type stocks are going to benefit in this administration. All right, let's look at another new one here. Let's look at Digital Turbine here. APPS is the ticker symbol. It's a 98 strength rank, currently at a hold. Again, I just like that stair step that it's in. Nice move up right here. A little correction, broke out higher. Looks to be pulling back a little bit here. Now it has gone back to a buy signal today. Like I said, that'll show up tomorrow. It'll be off the list tomorrow. Now this, you see the way it pulls back. Usually, here's the initial move. There's the bounce. Here's the next move down that forms that ABC. What concerns me a little bit on this is that it didn't have much of a back and forth on this drop. It looks like a straight drop. It looks a little sluggish in here. I'm worried that maybe this is kind of that wave A, this is wave B, and it could have another move down for wave C before resuming that. Usually that wave B doesn't go to a buy signal. So usually you don't have that problem when you're, you can see right here, usually well, actually, this did have wave B. It did have the bicycle on wave B. But a lot of times, the wave A is deep enough to where it goes to a hold, and then the B bounce still remains a hold, and then it still remains a hold down on wave C. So that could be one that you wait to see if the market breaks out as well, to get into, even though it's giving you the buy signal right now. You could wait for that little bit additional confirmation if you wanted to. I wouldn't wait for it to break out again. This one's not close enough to a breakout here. But if the market breaks out and this is still moving with the market, still moving higher, and you're moving up with it, then that you could consider that as an entry on that buy signal there. And let's do one more. This BILI, it's a 97 strength rank, BILI right here. Kind of the same thing. It's come off of a really strong trend here, or a sharp sell-off. It looks like it's coming back as a buy signal today. But there again, this is kind of similar to where could this just be wave A of the correction, wave B, and then you get wave C. Again, another one of those that you have to maybe see if the market breaks out, but I like the trend. I like the overall trend there, and it depends on how long are you trading it, or are you holding it for a longer term. If you're holding for longer term, you don't get too worried about, is this pullback wave A? Is this pullback done, or is that just wave A? Because even if it does come back down here a little bit deeper, you're holding on to it for a longer term, and that trend should resume, and you should be fine over time. So, all right, let's get into talking more about Elliott wave. Now, last week we talked about last Thursday we kind of did the introduction, a little bit of the background, and we talked about cycles, and that's what Elliott discovered, was that markets tend to move in these cycles, and the cycles are basically these what he calls waves. And in an advancing trend, like a stock moving up, the advancing move, or you'll often hear me talk about or call it an impulsive move, it usually shows. Oops, hold on here, let me erase this. It usually shows 5 waves. So you'll have the initial start of the trend. You'll get a little bit of a pullback. Wave 2, wave 3, you'll be advancing. Wave 4 is correcting. Wave 5. Now this goes back to when we first started talking about chart analysis. The basics I went over with you and what I want you to start to look for, and what we point out all the time when we look at these individual stocks that we're looking to trade, is that stocks will trend in a stair-step manner, meaning they don't go straight up or straight down. They tend to stair-step. They'll get a burst of a move and then a step, a little bit of a pullback, burst of a move. We saw that today on these stocks that were moving sideways. That step could be a pullback, or that ABC, or it could be just a sideways move. But they stair step. Now, what we're going to add here to that basic understanding, and what Elliott discovered, is that there's a number of steps there to it, meaning that you'll have, usually within a trend, you'll have basically 3 advancing moves: wave 1, wave 3, wave 5, and then you'll get these steps or corrective moves, which are your wave 2 and your wave 4. Now we'll build on this here. We want to understand the concept. And then once those 5 waves are done, then you go into a larger ABC correction, larger pullback. He also discovered that there are waves within waves, or subwaves, and we can identify where the market is in its current wave count on the long-term yearly chart, as well as a short-term hourly chart or intraday chart. And this process, we'll come back to this chart here in a second. This process is referred to as fractal, or a fractal process. I mentioned this a little bit last week. Fractals are mathematical structures which, on an ever smaller scale, infinitely repeat themselves. The patterns that Elliott discovered are built in the same way. An impulsive wave, which goes with the main trend, always shows at least 5 waves, at least 5 waves. Now, there are situations where it could be more than 5 waves. I'll talk about that in another class, but at least 5 waves. On a smaller scale, within each of the impulsive waves of the before mentioned impulse, 5 waves can again be found. Now, I'm going through kind of definitions here. I'll go back to that chart and I'll explain what all this is talking about here. In this smaller pattern, the same pattern repeats itself over and over. These ever smaller patterns are labeled as different wave degrees in the Elliott wave principle. I'll get into those different degrees here in just a second. But going back to this chart here, is basically what that slide was talking about, is that stock or these trends tend to form, or tend to be kind of a building block, or form in kind of a building block fashion. In other words, these smaller waves, these smaller wave 5s here, 1, 2, 3, 4, 5, is part of building a larger 5 waves, this larger wave 1, 2, 3, 4, 5. And that can be part of building an even larger wave of 1, 2, 3, 4, 5. Now, a couple things to point out here, and this kind of ties into last week as well, if you were here last week. We're understanding the concepts of this first, okay? The practical application of this is going to be a little bit different. And what I mentioned last week is I'm not an Elliott wave fanatic. I'm not believing that every chart has this perfect 5-wave, 3-wave process. Okay, I've been doing this a long time. I've looked at a lot of charts, and that's what frustrated me early on. Is I got excited when I learned about this, and boy, this is cool stuff. But then trying to apply it and apply it on some stocks that look like they were, they didn't look anything like this. They, you look at some stocks that you'll pull up, and they're trading like this. And you're like, I don't see any waves in there. I just see the stock moving sideways. That's okay. We're not going to be able to see this process perfectly in every stock that we're looking at, and that's why it's important to focus on the underlying principles of this, or the foundation of this. When we're going to have some other classes coming up, where I'm going to talk about the psychology of the wave counts. What type of conditions exist in a wave 3 or a wave 4 or a wave 5, and that stuff is even more valuable. Or even just a stair-step process. Instead of worrying too much about being able to identify which is, can I see a wave 1, 2, 3, 4, 5? Just like we talked about in the update, if you see a stock that's trending up and it's starting to move sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's likely to go after it's done moving sideways. And it works like this all the time. And I don't have to be able to know if that first move I looked at was wave 1, or if that and this is wave 2 and this is wave 3, or if this was wave 3 and this is wave 4 and this is wave 5. I don't have to get so hung up on what the wave is to be able to trade it and make money with it. So, but on some stocks that do show a pretty clear process, and we'll look at a couple of examples here that we can consider. What's valuable in understanding this fractal process is that you can determine many times where you are within that trend. Am I in the beginning stages of that trend? Am I in a wave 1? Now, how valuable could that be if this stock had a big, I'll go off of this here, it had this big correction pulled all the way back. And what happens after this correction? It should start a new 5 waves up, right? So let's say I have the stock that's come way down. It looks like it has this big correction, and it looks like I can see 5 waves here. And then here's a 3-wave pullback right here. Well, the value in this is I can say, boy, this looks like I'm in the early stages of a new uptrend. that looks like a wave one. This looks like a wave two. I'm not looking for a $2 to $3 move on this stock. This stock could give me a $20 to $30 or $50 move. I could trade the wave three, the wave four, the wave five. I can be in this thing. I'm expecting this thing to make a pretty big run. Now, whether it does it or not, again, that's another story. But that's valuable. Okay. Now, on the other hand, what if I see that there's this looks like wave one, wave two, wave three, wave four, and maybe I'm getting a move up right here with a little correction right here, and I want to trade this. Well, if I can see what looks like it looks like it's already completed wave one, wave two, wave three, and wave four, I'm probably in wave five. I'm probably in the last part of the trend. Now, could I still make money trading the last part of the trend? Absolutely. In fact, the nice thing about trading the later part of the trend is that you're in an uptrend. I can look back and see that we've been stair-stepping up. Okay? But I might be only looking then for a $2 or $3 move because it might not go up very much further. So again, I might adjust my trade or adjust my expectation. So that's where Elliott Wave can be very valuable, is in we'll talk a little bit more about this in a later class, talking about being able to see the context of where you're at and what you're looking at. But that can be very helpful. Okay. But the key thing here is to understand that the fractals, and if you look, we don't have the ability to do it on TradersPro, but if you have another charting service you use and you look at it like a 5-minute chart or something like that, an intraday chart, you can see the same thing. You can see the same stair-step process, and that's what's happening is those smaller stair steps are building larger. So, this stair step on a hourly chart is building this larger stair step on the daily chart, which is building this larger stair step on like the weekly chart, or over the next year or 2 years or something like that. Now, I mentioned in that previous slide on fractals that each of these moves, each of these are different wave degrees. So this is a wave degree. These smaller 5 waves are a wave degree. Builds a larger wave degree. Which builds an even larger wave degree. And Elliott labeled these. Now, this is not critical that you know all these names particularly. More importantly is understanding the concept that those smaller degrees are building larger degrees. But he labeled these and gave them names. He said all waves may be categorized by relative size or degree. Elliott discerned 9 degrees of waves from the smallest wiggle on an hourly chart to the largest wave he could assume existed from the data then available. He chose the names listed below to label these degrees from largest to smallest. The largest is what's called the grand supercycle, often referred to as the millennial degree, thousands of years. Now, obviously, our markets haven't been around for thousands of years, but what's interesting about this, about Elliott wave analysis, is you can go back and you can analyze history. Last week we talked about cycles. Well, there are different cycles in history, right? The Roman Empire rose and then it fell. And you can go back and you can find the same approach in world history. The kind of these rises and falls, this kind of stair-step process, so to speak, throughout history. Now, obviously, it doesn't matter where we're at within a grand super cycle or millennial degree, because nothing in these first few cycles are going to have anything to do with the trade I'm going to get into for 2 or 3 or 4 days or something like that, or 2 or 3 or 4 weeks. If you're curious though, he a lot of the Elliott wave technicians out there believe that we're in a wave 5 of that grand super cycle right now. So if you believe in a end of the world Armageddon type event upcoming, this would kind of back that up, that we're in that final stage in the existence of the world, so to speak, based off of Elliott wave. Now, like I said, that's maybe kind of interesting, but not going to be helpful for our trading. Super cycle degree, a little bit smaller, but still too big to really affect us. 100-year cycle. And they believe that we're in wave 5 of that super cycle, or excuse me, the super cycle degree. Cycle degree, maybe the largest one that I would even consider would be, maybe the monthly chart looking at 10 to 20 years of data. You might be able to kind of, and by the way, sometimes in the when you zoom out, you can see some of these wave counts a little bit easier, like on a monthly or weekly chart. You can see where at least the larger trends are maybe a little bit easier to see a lot of times. It's really hard to see Elliott wave in the 1 minute chart or the real close up, because there's just too much back and forth that can happen. I mean, it's there. That's what's happening, is those waves are building larger waves, but a little bit harder to see. Primary degree would be 1 to 2 years, basically looking at a weekly chart. Now, this is where we'd get into more of what you use for your trading. Intermediate degree would be like your daily chart, looking at the last couple months or a few months, maybe last 6 months or so. Minor degree would be maybe your hourly chart. And then minute, minuet, sub-minuet. Basically, the sub-minuet would be your 1 minute chart. They even now have, 5-second charts and things like that. That's just crazy. I guess if you're that'd be almost more like a high frequency trader would consider. And at that point, the computer's doing all the trading for you anyway. So, but we're not going to be messing around too much with these ones either as traders, just unless you're really doing, day trading. But even day trading, I wouldn't see the value in looking at a 1 minute chart. It's kind of zoomed in a little bit too much for most of your decision making on that. So again, this is kind of nice to know. You don't necessarily need to know the names of these. More importantly, is that you understand just the concepts that these are building blocks. He even has a special labeling system for those. Now, this is almost kind of funny to point this one out, and I'm not going to spend much time on this, because this labeling would make sense if you were drawing something on a chart, but I don't see a real easy way on my computer keyboard to draw a Roman numeral 1 with a circle around it. Maybe the parentheses would be a little bit easier, but it's just not practical. So I think the important thing is when you're labeling that you can tell you can separate the different wave degrees. So if I go back to this chart here, I use this type of approach, which is just the font size. You see, I'll use a smaller wave 1, 2 to label a smaller degree, a larger wave 1 and 2 to label a larger degree, and an even larger, or you might even add parentheses at that point to differentiate an even larger degree. But usually I'll just use a larger font size. And but the key is just being able to recognize that what you're looking at, the different degrees that you're looking at. So another question that gets asked a lot is, well, what happens then when you reach the 5 waves or top of the trend? Well, you get these corrections, and you can have a really large, bull market for a long time, number of years. And then what happens? You get a big sell-off, you get a bear market. We've had market crashes, Usually those are going to be your ABC corrections. And then once those are done, the idea is that you start another 5 waves. So the idea is that you're always advancing upward. You're always going forward. And you can see that over world history where, if you want to look at examples is, the Roman Empire was kind of like the peak of a wave 5, and when it collapsed, you went into the Dark Ages, and that was your ABC correction. And then since then, what's happened? You started to advance forward again to where we are now with all the technology we have now. And if you believe that we're in kind of the wave 5 of the grand super cycle, then boy, the technological advances that we've had. I mean, it's amazing at what we keep coming up with. But what do you also start to see? Well, you're starting to see how this technology, especially artificial intelligence, could destroy everything. I don't know if you follow some of these updated stories, but it can get pretty scary of the advances that we're making, to the point of it could end up being to our destruction. And it's like I said, if you're really fanatical about this, you could be thinking that, man, we're gonna have this massive correction taking place at some point, which I don't know if I want to be around for. All right. I want to finish up this part, the slide part of this, and we'll look at some examples here and then finish up class today. I want to finish up with a quote. Well, actually, here we have a slide where you can see it's kind of a slide of the Dow over like a 100-year period or so. A lot of technicians believe we peaked wave 3 at the roaring 20s. The Great Depression was wave 4, and since then we've been advancing in kind of a 5-wave, wave 5. I think this particular labeling has to be updated there. I just wanted to kind of show the example of that. And then here's an example of a intraday chart. Here is an ABC correction for a larger wave 4, then it started wave 5 right here. Within that wave 5, there's wave 1, wave 2, wave 3, wave 4, wave 5. Within this wave 1, you can see a smaller wave 1, 2, 3, 4, 5. And it'll be, like I said, we get into some of the wave characteristics, wave rules. Those are all coming up, classes that are coming up that'll help explain a lot of this. Now, I want to finish up before I go into the examples with a slide right here. Robert Prechter, who's kind of the leading guru or expert on Elliott wave analysis today. He's really pioneered what Elliott started, but like I said, his group is pretty fanatical about the stuff, believes it explains all kinds of stuff and can predict a lot of stuff. And I think it's a little bit too much for me. I just don't. I tend to take a little bit more of a balanced approach to it. But it's this quote is fascinating because it really does explain. It can explain exactly what's going on right now with the Reddit crowd. But he said that the Elliott wave principle exists partly because man refuses to learn from history, because he can always be counted upon to be led to believe that 2 and 2 can and do make 5. He can be led to believe that the laws of nature do not exist, or more commonly, do not apply in this case. That what is to be consumed need not be first produced. That what is to be led need never be paid back. That promises are equal to substance. That paper is gold. That benefits have no cost. That fears which reason supports will evaporate if they are ignored or derided. I think what's fascinating to me, and I've talked about this in the updates, is that back in the internet bubble, what caused the crash and all that back then was these companies that were coming out they were basically a business plan. They didn't even have they weren't even making any products or selling anything yet. And people were buying the stock of these companies, or they're buying kind of the dream, so to speak. And obviously that couldn't last. But at the time, I remember the value that people were saying that these valuations are crazy. There's no way this stock that isn't making any money is worth $500 a share. But the rationalization back then was, well, you don't understand it. It's different. You can't be measuring evaluations like you do a bank stock or something like this. Is technology. You've got to have a different approach to it. It's not the same. This is different, and that fooled a lot of people. They said, "Oh, it's different this time. I'm jumping into these stocks," and they got hammered. They came crashing down. Now, a lot of them went out of business, but some of them survived and came back again. But I remember that distinctly, that they were talking about how it's different, that you can't apply the same principles that you've applied to IBM and GM and all that over 100 years. It's different this time. And we had that crash. Well, next time around, again, history repeats itself, right? We're right back in this situation where, now we've got people targeting shorts and trying to profit off of short selling. And what are we hearing a lot? We're hearing a lot of, it's different this time. You're telling me that this is how short squeezes usually work, and they usually end badly for people buying, especially people buying in at the top. It's different this time, And so that's what is I think the lesson with Elliott Wave that we can learn, and is that in kind of the foundation of what we look for in these charts is that, these things will just keep repeating themselves. And they do repeat themselves because what is Elliott Wave based on? It's based on human nature. And humans will always tend to repeat the same mistakes or do the same thing. All right, let's look at a couple examples of this. Let me go back to the charts here. And let's take a look at JMIA, JMIA. Yeah, I'm going to go to a one-year chart to see this a little bit better. So if I were labeling this uptrend on JMIA, obviously it was consolidating for many years. So I'm not too worried about what the labeling is there, because this is where we kind of started the uptrend right here. But I would label this as wave one. We pull back here for wave two. We had this run up right here, which I believe was wave three. This pullback here for wave four, and then where it looks like we're in a wave five. Now, why do I think this labeling is pretty decent? Well, look at within that wave three. I should be able to see smaller waves. This looks like wave one. I'm going to use lowercase Roman numerals for this. This looks like wave two of three. Wave three of three. Wave four of three. And wave five of three. And then you had this ABC for wave four. And then it looks like this is wave one of five, two of five, three of five, four of five, and it looks like we're in wave five of five. Now, I don't know if this is how it'll play out. If based on that labeling, we're probably due for an ABC correction. Wave A, wave B, wave C come down, maybe down to this area before we start trending back up again. Now, could we stay in this wave five for a while? Could we rally for a few more weeks or so with that? Absolutely. But And I might see that I really like if we zoomed in, I might really like the pattern here. We can go back to a 6-month chart here. I might, maybe there's something I don't like the price action today on that. It looks pretty bearish today, but I might look at this and still like it to keep going up for a few more days or for a $2 or $3 move. But because that context, seeing that whole context there and seeing that it looked like it could be in a wave 5, it might cause me to say, I'm going to do a real short-term trade, 1 or 2 day trade at the most on this. Let's see if I can get a $2 or $3 or $4 move and get out. And so I can still trade it, but I'm obviously, by seeing that context here, I might choose to shorten the expectation of how far I think it's going to go. Or I might say, boy, I really like the stock, but it looks like it's going to have that larger ABC correction. Let's wait for that. And by the way, one that we've kind of looked at recently was Zoom. And I haven't looked at the wave count on Zoom, but anytime I see a large pullback, I assume that it's the bigger correction. So we had this big run up here. Let's look at a 1-year chart here real quick. So we had this big run up last year. This looks like an ABC. I pointed this out when we were looking at this chart last week. This looks like wave A, wave B, wave C. And if that's the case, this looks like an impulsive move up right here. So that might be wave 1 of a new uptrend. This is kind of choppy right through here. That could be wave 2. Oh, we can just use regular 1. This looks like wave 2 of a new uptrend. I mean, this thing could maybe end up all the way up here somewhere when it's all said and done. Now, I don't know that for sure. And Elliott wave, believe me, does not predict the future, as some people might say it does or claim it does. You still have to manage your trades and manage your risk and all that. But based on the context, I really like that because this looks like it's starting a bigger move. This might be something that I would buy and hang on to for several months, not be looking for a $2 or $3 move. Okay. All right. Next class, we're going to get into the Elliott wave rules. There are rules that govern these wave counts, and those rules are very important because without them, you could get any type of wave count you wanted to. And if you were bullish on a stock, you could find a wave count that would tell you that stock is going to go up. And if you were bearish on a stock, you could find a wave count that tells you that stock is going to go down. And then what good is any of the analysis at that point? You're basically telling yourself what you want to hear. So there are some rules that can help tell you when, hey, I thought the stock was going to go up, but now it's breaking these rules. That can't be that wave count I just put down is not accurate. I have to rethink this. Anyway, we'll get to that next week. We'll introduce the wave rules, on Thursday. We'll introduce the wave rules after we do the stock-specific class on Thursday. All right, thanks, everyone. Have a great week. We'll see you Thursday for the stock-specific class. Bye now.